Hello everyone. Welcome back to Gold Rush Reporter. This channel is dedicated to clear, no-nonsense gold and silver market analysis, focusing on what actually moves price, not hype, not headlines taken out of context. Now today's topic is critical, and frankly, most people are not taking it seriously enough. On January 1st, China made a move that fundamentally changes the global silver market. Not temporarily, not cyclically, structurally. And if you understand what just happened, you'll also understand why the silver market is entering a completely different phase. China has officially restricted silver exports. Let's be precise here. This is not a rumor. It's not speculation. New Chinese policies restricting silver exports went into effect at the start of the year, tightening Beijing's control over a metal that is already in chronic shortage. This matters for one simple reason. China is central to the global silver supply chain. China is one of the world's largest silver producers, one of the largest refiners, and one of the largest consumers. And now, at a time when silver has been added to the US critical minerals list, China has effectively said, "We're prioritizing our own needs first." That is not an emotional decision. It's a strategic one. Silver is essential for solar panels, electronics, EVs, batteries, medical equipment, and advanced manufacturing. These are not optional industries. These are core to economic and military competitiveness. When China restricts exports of a strategic input, it is sending a very clear signal about how it views the future. And here's the uncomfortable truth. The rest of the world depends on that supply. This is why the phrase, "you've had your share," isn't hyperbole. It's reality. When the largest player in the market tightens exports, everyone else has to compete harder for what remains. And when supply is already tight, competition means higher prices. The timing is also important. Silver inventories were already strained. Physical premiums were already elevated. Industrial demand was already rising. Now you layer export controls on top of that. That's not bullish speculation. That's supply shock. We saw immediate reactions across global markets. Silver prices surged in certain regions, particularly in parts of the Middle East, where local pricing briefly moved far above Western paper prices. That divergence alone tells you something is broken in price discovery. When the same metal trades at wildly different prices depending on location, the issue isn't demand, it's availability. This move also caught the attention of major industrial players. Elon Musk publicly criticized the decision, pointing out that silver is essential to many industrial processes. That's not surprising. Companies like Tesla, SpaceX, and major tech manufacturers consume massive amounts of silver. They don't buy coins. They buy tonnage, and they need reliable, long-term supply. Here's the key takeaway you need to internalize. When industrial giants start worrying about access to raw materials, the market is no longer just about investors. It becomes about survival of supply chains. And that changes behavior. Governments stockpile. Corporations lock in contracts. Investors hoard physical metal. All of that removes supply from the open market. And when supply disappears, paper pricing becomes increasingly irrelevant. Now, I want to be very clear. This does not mean silver goes straight up in a line. Volatility is guaranteed. Corrections are inevitable. But structurally, the floor has moved higher. China's decision echoes what it previously did with rare earth elements. At the time, many dismissed it. Years later, the consequences are still being felt across global manufacturing. Silver is now following a similar path. Now that we understand China has restricted silver exports, the next question is, how does this affect the broader silver market, especially the paper side of things? Let's start with COMEX, the world's largest commodity exchange for precious metals. This is where the majority of futures contracts for silver are traded. While physical supply is tightening in China, COMEX has an outsized influence on pricing, leverage, and trader behavior. Just recently, the CME Group raised margin requirements on silver futures. For context, margin requirements are the amount of money traders must post to maintain positions. When the CME increases margins, it forces traders to post additional capital or liquidate positions, which can trigger rapid sell-offs, even if the fundamental outlook hasn't changed. Why did they do this? They cited heightened volatility after a massive year-end rally. Silver surged earlier, hitting over $80 per ounce in some regions, before pulling back to around $72 in the US markets. From a technical standpoint, that pullback looks alarming. But structurally, it was a mechanical reset, not a reversal of the bull market. This is critical. Margin hikes do not reflect a weakening market. They merely adjust leverage. When combined with China restricting exports, this creates an interesting dynamic. Paper prices may swing wildly, but physical metal remains scarce and increasingly valuable. In other words, volatility is amplified on the futures side, but the physical market tells a different story. Let's look at the numbers. Physical silver premiums have soared due to high industrial demand, while inventories are at record lows. Reports indicate some Middle Eastern markets saw silver prices jump as high as $127.45 per ounce, nearly double US prices. That's a 34% gain in a day, illustrating the stress in supply chains when access to physical metal becomes restricted. Industrial consumers are feeling this too. Companies like Tesla, SpaceX, and other tech giants rely on silver for batteries, EV components, and electronics. Elon Musk even publicly criticized the export restrictions, highlighting how essential silver is to advanced industrial processes. When major companies express concern over supply, it underscores that this is not just a trading issue, it's a real-world bottleneck. CME margin hikes also interact with this physical scarcity in a feedback loop. Paper traders adjust positions, futures prices fluctuate, but physical demand remains strong. The result is increased volatility without a reduction in underlying value. This is an important distinction for investors. Short-term paper movements may look dramatic, but they mask the structural bullishness of silver. Here's a key takeaway. Recent price dips to around $72 should not be seen as a market top. Rather, these corrections are healthy and expected, especially after a sharp rally and mechanical adjustments from exchanges like COMEX. They are opportunities for investors to buy dips, not sell out of fear. Another factor amplifying volatility is the interaction between investment demand and supply shortages. Exchange-traded funds, ETFs, physical purchases, and growing awareness of silver scarcity all combine to create sharp upward pressure during rallies and sudden but temporary drops when futures contracts reset. Finally, it's important to note the long-term structural drivers remain intact. China is prioritizing domestic supply. Industrial demand continues to grow globally. Inventories are low and premiums are rising. Geopolitical uncertainty is pushing investors toward tangible assets. All of this points to a market where volatility is the norm, but the underlying trend is bullish. Short-term swings may scare some traders, but informed investors can see this as an opportunity. Now that we've covered China's export restrictions and COMEX's margin interventions, it's time to focus on why silver is poised for further gains in 2026. The story isn't just about volatility or paper markets, it's about real-world supply, industrial demand, and strategic positioning. First, the supply side. As we discussed, China controls a massive portion of global silver production, and with export restrictions in place, a significant portion of global supply is effectively removed from international markets. This is not a temporary hiccup, it is a structural shift. Add to that the reality that physical inventories are extremely low, and you have a market where industrial users, investors, and even governments are competing for a shrinking pool of metal. Physical silver is not fungible like paper contracts. It must be sourced, refined, transported, and stored. And now China is restricting its export, meaning availability outside the country is immediately constrained. This ties directly into industrial demand. Silver isn't just a store of value, it's essential to multiple industries. Solar panels, EV batteries, electronics, medical equipment, and other high-tech manufacturing all rely on silver. Demand is growing, not shrinking. Elon Musk's public comments on the restrictions highlight this point. Companies like Tesla and SpaceX require massive amounts of silver to operate, and any supply squeeze creates immediate operational risks. Then there's investment demand. After silver's historic rallies in 2025, global investors have become increasingly aware of silver as a hedge against monetary instability. Physical silver purchases, ETFs, and even mining stocks all contribute to demand pressure that exchanges cannot absorb indefinitely. When paper markets become volatile, investors often turn to physical metal, further tightening the gap between supply and demand. We also have to consider pricing signals. Despite recent corrections caused by COMEX margin hikes, structural drivers remain extremely bullish. A dip to around $72 per ounce should be interpreted as a strategic buying opportunity, not a sign that the bull market is over. The market needs these corrections to reset speculative excesses, but they do not reflect a weakening fundamental story. Looking at 2026, multiple factors suggest further gains are likely. Restricted supply from China. The biggest silver producer is now prioritizing domestic use. That reduces global availability for investors and industries. Rising industrial consumption. Silver-intensive sectors continue to expand, pushing demand higher each year. Physical premiums rising. Evidence from Middle Eastern markets shows prices diverging sharply from US futures, signaling scarcity. Geopolitical and monetary uncertainty. Investors seeking protection are increasingly turning to tangible assets, reinforcing upward price pressure. Taken together, these trends suggest silver is entering a new phase of structural scarcity. Unlike the speculative rallies of past years, this is not driven solely by sentiment. It is a fundamental imbalance, and history shows that markets correct these imbalances quickly when scarcity becomes visible. That means 2026 is shaping up to be one of the most important years for silver in recent memory. Investors who ignore structural supply constraints risk paying higher prices later. Those who understand these dynamics may be positioned to capitalize on the next leg of the bull market. Finally, remember the broader lesson. Silver is unique because it is both a monetary asset and an industrial necessity. That combination magnifies the impact of any supply restriction. Unlike gold, which is primarily a store of wealth, silver's scarcity directly affects production and consumption. Now that we understand the supply shock and structural drivers, it's time to discuss how investors can actually position themselves in this environment. China's silver export restrictions have created a rare market dynamic. Tight physical supply, growing industrial demand, and rising premiums. These conditions favor strategic allocation, but only if approached carefully. First, let's talk about physical silver. This is the simplest, most direct way to benefit from scarcity. Owning coins or bars ensures you are holding an asset outside of paper markets, which are subject to margin adjustments, trading halts, and speculative swings. Remember, COMEX and other exchanges can raise margins or temporarily shut down trading, like they have in the past. But physical metal is real and tangible. Currently, Prices in the US hover around $72 per ounce, significantly below what silver is trading for in some overseas markets. In the UAE, for instance, silver reached $127.45 per ounce in late December. That divergence illustrates the importance of sourcing from reliable suppliers. A trusted dealer, like Miles Franklin, ensures not only authenticity, but also availability. Building a relationship with a supplier allows you to access inventory before premiums escalate further. Beyond physical silver, mining stocks offer leveraged exposure to the bull market. Unlike coins, mining equities move with the company's operational efficiency and growth potential. In a market where physical silver is restricted, companies with access to supply and strong production pipelines benefit disproportionately. But, as always, caution is required. Not all miners are created equal. You want companies with proven management and strong insider ownership, high quality, underexplored deposits, access to financing for expansion and drilling exposure, primarily to silver, rather than byproduct metals. These factors mitigate risk and amplify potential upside in a bull market. Mining equities often underperform the metal early in the cycle, then explode as the market recognizes their value. Next, consider timing and market behavior. Following a sharp rally, like the one that brought silver to over $80 in late 2025, corrections are natural. These dips, like the current $72 range, are often the best entry points. They allow investors to accumulate positions before the next leg up. The key is discipline. Buy the dip, hold through volatility, and avoid chasing spikes. Investment demand is also rising. ETFs, retirement accounts, and industrial hedging are adding pressure to physical supplies. Every ounce that moves into investment hands is an ounce removed from commercial and industrial circulation, further tightening the market. This dynamic is often overlooked by casual investors who focus solely on futures prices. Finally, remember the geopolitical and structural context. China's export restrictions are not a one-off event. They are a strategic maneuver similar to its rare earths playbook. This signals a long-term commitment to controlling global silver supply, meaning scarcity may persist for years. Industrial users, investors, and nations will all have to adapt to a tighter, more constrained silver market. Here's a practical takeaway. 2026 is shaping up to reward preparation and strategic positioning rather than speculation. Physical metal, quality mining stocks, and early access to reliable sources are all crucial. Avoid reactive trading based solely on headlines. Instead, focus on structural drivers, supply constraints, industrial demand, and long-term investment flows. Now, we're at the point where we can step back and connect all the dots. China's export restrictions, COMEX volatility, industrial demand, and investment trends are converging to create a very unusual silver market. Understanding this is essential for any investor who wants to avoid mistakes and capitalize on opportunities in 2026. First, let's talk price outlook. Structurally, silver is in a bull market driven by scarcity, industrial demand, and strategic stockpiling. While volatility will continue, the underlying trend is unmistakably upward. Prices dipping to the low 70s should be seen as opportunities to buy, not a signal that the bull market is over. Analysts and market observers have been projecting significant gains in 2026, with many suggesting silver could test $100 per ounce or higher. Keep in mind, these aren't random guesses. They're based on fundamental constraints. China controlling exports reduces global availability. Physical inventories are near record lows, making it difficult to meet both industrial and investor demand. Premiums on physical silver are rising globally, signaling scarcity. Geopolitical and economic uncertainty drives investors to tangible assets. Combined, these factors create a structural floor under silver prices. Even short-term corrections, like the recent pullback from over $80 to $72, are temporary mechanical resets, not a weakening trend. Now, let's address the risks. Volatility is unavoidable. Futures markets will swing wildly due to margin adjustments, speculation, and trader psychology. Mining stocks will fluctuate based on drilling results, operational risks, and financing needs. Even physical silver can experience temporary supply bottlenecks and pricing gaps across regions. However, risk can be managed with a strategic approach. Physical silver: hold tangible assets purchased from reliable sources. Build relationships with dealers who can provide access and support in a constrained market. Mining stocks: focus on companies with proven management, strong insider ownership, high-quality deposits, and access to financing. These companies benefit most in a bull market. Buying dips: use market corrections as entry points. Don't chase spikes. Discipline is more important than timing perfection. Long-term perspective: understand that this bull market is structural, not speculative. Short-term paper movements are noise. Long-term trends are what create wealth. Another important aspect is industrial demand and strategic stockpiling. Corporations and governments are increasingly locking in silver supply. When industrial players or nations act to secure future production, it removes metal from the open market, creating upward pressure on prices. This is especially true in a year when China is restricting exports. Geopolitics also plays a role. Rising uncertainty in global trade, monetary policy, and industrial supply chains ensures that precious metals remain a safe haven, not just an investment vehicle. Investors ignoring this macro backdrop risk losing out on structural gains. To summarize, the 2026 silver landscape is shaped by real scarcity, strategic controls, and robust demand. Short-term volatility will occur, but the fundamental trajectory points higher. Prices above $80, $90, and even $100 are realistic, particularly as the year progresses and supply tightens further. Finally, a key takeaway: silver is no longer just a commodity, it's a strategic asset. Investors who treat it as such, by holding physical metal, selecting high-quality miners, and planning for the long term, are positioning themselves for potential significant gains. Those who react emotionally to price swings or ignore supply realities risk being left behind. So, in 2026, focus on the structural drivers, act strategically, and respect the volatility. Silver is entering a new era, and for those prepared, the rewards could be extraordinary. Thank you for watching Gold Rush Reporter. Stay informed, stay strategic, and keep your eyes on the metals that matter most. I'll see you in the next update.